Hi, I'm Tom Lydon, editor of ETF Trends here in New York at the ETF Bootcamp, and I'm here with Dodd Kittsley, who's head of National ETF Accounts and Strategy at Deutsche Asset and Wealth Management. Dodd, great to see you.
Great to see you as always, Tom.
Thanks for being a part of this, and on our first panel keynote session today, we talked about all the dynamic ways that this ETF business is growing, but specifically, one asset class that you folks are really concentrating on is currency. And the average investor and even average advisor hasn't really spent as much time on it, but now we really need to spend time on it, considering what's going on.
Absolutely, and it is one of the fastest growing segments of the ETF industry. It's gone from 14 billion 12 months ago to now over 70 billion. There are a lot more solutions out there. We launched 10 last month, additional currency hedge solutions, but you're right, it is one of the most important stories and lessons in the capital markets over the last 5 years, and that's a recognition of the impact that currency has on both the risk as well as the return of any international equity investment. And these are democratizing the ability to control for what we believe for many investors is an unintended risk, and that's currency.
Well, let's talk about the basics here, just to develop markets. We've got quantitative easing kicking in Japan and in the EU,
yes.
Right? And then here in the US, we're facing the threat of rising interest rates, so that pushes foreign currencies in lower valuations, our currency with higher rates, a greater dollar, correct?
Absolutely. We think we're about halfway through the US dollar strength. And that's a common question we get from folks since the dollar moves so quickly over the last 18 months or so. But when you look at historical trends in the US dollar, the typical duration of dollar moves up and down is 8 years. The typical magnitude is about 55 to 60 percentage points. We're only 4 years in about 30 percentage points up. So we think we're about halfway there, just on historical, but on fundamentals, as you say, divergence in central bank policy and talk of even additional measures by the ECB is really driving capital flow into the US fixed income and making rates very, very attractive.
So when you look from a global perspective here as maybe an advisor, an investor, an institution in the US, you've got allocations in foreign markets like Europe or like Japan. And those markets, especially Europe, has corrected pretty significantly. You're about to go into rebalance mode at the end of the year, right? There's a good chance that at one point, hopefully QE will kick in and we'll see some type of recovery. But if the currency continues to slip, you're not getting it all, right?
Yeah. Absolutely, and I think that's the experience of a lot of investors where they're scratching their head saying, you know, I made the right call in the underlying markets. Stocks have actually done pretty well, but when you take into account the erosion impact of a stronger US dollar on an unhedged investment, it's obliterated all of the good returns.
So quick strategy for the average investor or average advisor. It's not like you've got to go all in from a hedge standpoint, but a simple rule would be?
Blending. We find a lot of advisors are using currency-hedged ETFs in a sort of 50-50 blend, right? Whether they have an active manager that's unhedged, which is the norm, or they have an unhedged exchange-traded fund. What they're doing is they're using a hedged in reducing the impact of currency to not have as much influence over their overall experience.
Right, great. Dodd, as always, appreciate it. Thanks so much.
Pleasure, Tom. Thank you.